What's the real difference between a private dream and a public reality? Well, for a company, it's a journey that can literally create billionaires or completely break its founders. Today, we're diving into that super high-stakes transformation, the initial public offering, or as you know it, the IPO.
You know, it really all comes down to this one massive choice. Why do some founders clutch their creation so tightly, keeping it private, while others take this huge leap of faith into the public markets? It's this constant tug-of-war between autonomy and opportunity, and it shapes the entire future of a business.
All right, to really get this, we need to understand that we're talking about two completely different worlds here, the private company and the public one. They play by totally different rules, face different pressures, and have very different ideas of success.
At the end of the day, it's all about a critical trade-off. Private companies, they're all about control. With just a few owners, they can be super flexible, think long-term, and not have to worry about the tyranny of the quarterly earnings report. Public companies, though, they trade a chunk of that control for access to just massive amounts of capital and the kind of brand recognition you can only get from being listed on a major stock exchange.
And when you look at how they actually operate, the differences are just night and day. A private company's access to cash is like fishing in a pond. A public one, it gets the entire ocean. But that access comes with a hefty price tag, intense government scrutiny. And that can be a real culture shock. Decisions that used to be made quickly by a small group now have to please thousands of public shareholders. That changes everything.
So what is it that actually pushes a company from one world into the other? There's always a tipping point, that moment when the pros of going public finally seem to outweigh the cons. And you know what? Long before any official announcement, the company starts dropping clues that it's getting ready to make the jump.
And the reasons for making that leap, they are seriously compelling. First, of course, is the capital. An IPO can be a massive cash injection for growth. But it's also about the people. It's a way to finally pay back those early investors and employees by making their stock worth real money. And beyond the cash, there's the sheer prestige of a NASDAQ or NYSE listing. Not to mention, you can now use your stock as a kind of currency to buy other companies.
So if you want to play detective, here's what to look for. If a private company all of a sudden starts acting like a public one, upgrading its board, tightening controls, that's a huge red flag. Another big clue is something called a big bath. It's when they take a huge one-time financial hit to make future profits look way better. You might also see them bring in new execs who've been through this before, or sell off parts of the business that don't fit. They're basically getting lean and mean to create a simple, shiny story for Wall Street.
All right, so once the decision's made, the company starts what is truly a grueling marathon. The initial public offering isn't just one event. It's a long, complicated process that can easily take the better part of a year to get through. So what is an IPO? Simply put, it's the moment a private company officially becomes public. It's the very first time its shares are sold on a public exchange, making them available for literally anyone to buy.
And this process is a real gauntlet. It kicks off with a bake-off, where all the big investment banks compete to run the show. The winner then helps the company write this monster document called the S-1, which spills all the company's secrets for the SEC. Then comes the roadshow, basically a world tour where execs pitch to giant investors. All of this builds up to pricing day, when they finally set the share price, right before the main event. Launch day, when that opening bell rings and the stock starts trading.
Now, the traditional IPO is definitely the most common route, but it's not the only game in town. There's also something called a direct listing. Spotify famously did this. So what's the difference? Well, in an IPO, the company creates new shares to raise fresh cash. In a direct listing, only existing shares from insiders and early investors get sold. It's a cheaper way to go public, and the goal is more about letting early folks cash out than raising new money for the company itself.
You might think that ringing the bell on launch day is the finish line, right? Nope, not even close. It's the starting gun for a whole new kind of race. Life after the IPO is a completely different reality, and honestly, the change can be pretty jarring.
And that's the new normal. The company basically has to live in a glass house. Every single move is watched, every financial statement is picked apart by analysts and investors. That cozy privacy they had as a private company, yeah, that's gone forever.
And the new rulebook for this game is, well, it's thick. Can you imagine the pressure of having to report your financials to the entire world every 3 months? On top of that, there are super strict governance laws, and your company's value can now swing wildly based on things you can't even control. But maybe the biggest change of all, that precious autonomy is gone, replaced by the need to keep a board of directors and thousands of shareholders happy.
And besides all the operational headaches, going public is just plain expensive. The investment banks that guide you through the IPO, the underwriters, they take a huge cut, usually somewhere between 3.5% and 7% of all the money raised. Just think about that. On a billion-dollar IPO, that could be $70 million that never even makes it to the company's bank account.
Okay, so we've been talking a lot about the company as this big, abstract thing, but what does this all mean for the actual people involved? You know, the employees who poured their hearts into building it and the investors who are betting on its future.
One of the most critical concepts for founders and early employees to wrap their heads around is equity dilution. Okay, imagine the company as a pie. Before the IPO, an early employee might own a nice slice, but when the company goes public, it issues millions of new shares, making the whole pie way, way bigger. So that employer's percentage of ownership, their slice, gets smaller. But, and this is the key, the hope is that the entire pie has grown so much that their smaller slice is now worth way more than their bigger one was before.
And this quote just really hits you. It perfectly captures the human side of all these big money deals. This person on Reddit was working toward owning a piece of their company, but it got sold before they had the chance. It's a powerful reminder of the real personal hopes and financial dreams that are all tied up in a company's journey. But for the rest of us, the average investors, there's one massive benefit when a company goes public: transparency. Unlike private companies who can keep their finances totally secret, public companies have to open their books to everyone. That required disclosure means you, as an investor, can make a much more informed and hopefully safer decision about where to put your money.
And so we end up right back where we started, with this fundamental tension. Is going public the ultimate sign of success, the gateway to incredible growth and influence, or is it a kind of golden cage where you trade your freedom and long-term vision for the relentless short-term demands of the stock market? There's no single right answer, and it's still one of the biggest, toughest decisions any business will ever have to make.